Hi there, I'm Tyler Jeffcoat from Seller Accountant, and just wanted to thank you for joining our weekly video with me today. I want to talk to you about deals today. Seller Accountant has been fortunate to be in the room, so to speak, with some massive exits of our Amazon and other e-commerce brands over the course of the last 9 months. We've also, unfortunately, been aware of or have been part of the due diligence process for some deals that really didn't go that well. And so those are the deals I want to talk about today. I want to give you 5 things that we've kind of seen on a recurring basis as being deal killers. What are the 5 things that put a pause on the due diligence process or just lower the deal value, make it a lot harder to get the deal done? Ready? Let's dive in. The first one is hiding. Sounds really obvious, but if you had a bad, let's think about the last 12 months here as I'm sitting at the very end of the summer in 2021. Let's say you had some supply chain hiccups, you're stocked out, and your big Christmas rush wasn't quite the rush you thought it was going to be. Now you're going to market and you're tempted to try to hide that information from the buyer. Don't do it. It is so much better to be completely forthright. Hey guys, this is where I misordered. I bought too much of it. Hey guys, this is where I thought I was getting a good deal and had to end up air freighting it. Hey guys, here was a launch campaign that didn't go the way I thought it was going to go on this new product. Now we've got it fixed. Telling a coherent story that then can be verified against the data is going to give you a much better result. And in fact, will actually build trust with the buyer versus trying to work around haggle, because it's going to come out and it's going to erode trust. And the first thing you need for a deal to get done is trust. Don't hide from your buyer. That's the first item I want to mention to you. The second item is, if your business, especially the marketing part of your business, is predicated too much on gray hat or black hat tactics to be successful, that will normally come out during the course of due diligence, right? All of us have to have some kind of a creative launch strategy for our products. Those launch strategies sometimes include tactics that are not 100% TOS compliant from the Amazon perspective, and the game is what it is. But if your business marketing strategy is fundamentally predicated on black hat tactics, that probably means you don't have a great product that has enough value proposition on its own. And that, again, you just need to disclose it. Hey, here's how we're doing it, and expect that to harm the deal value, because the larger the investor is, the less room they have to be able to play games with Amazon's TOS. They're going to have to be compliant, which means your future business may not be as profitable as the old business. The second one, so the first one was don't hide. The second one is start weaning yourself off of the black hat tactics as soon as possible. The third one is the thing that kills the deals, and I've seen this over and over again, is bad books. This could be bad in 2 really important ways. Bad books, number 1, is a commingled set of books. That means I'm running my personal transactions through the same credit card and bank account and profit and loss statement as I am my Amazon or Shopify business. We've got to stop commingling these businesses and have a clean P&L just for the asset that I want to sell. The second definition of bad is cash basis, where we are not booking our sales in the month that they actually shipped, and we're not booking our cost of goods sold in the month that we actually shipped and sold those units. So commingled and cash basis are bad for deals. You don't want your books to be commingled and cash basis. Separate personal from business and accrual accounting is good. Getting deals done, especially as the numbers get a little bit bigger, is incredibly difficult if you don't have good accrual accounting that is completely, as far as you can possibly do this, separate from your personal finances. So that's the third killer, is having cruddy books. The fourth one, which you might think is a little bit connected, but it's not, is related to inventory tracking. We've had some sellers in the past that actually ultimately have pretty good accrual financials. I mean, they've hired us to do them. We're booking the sales and cost of goods sold in the right month. But when it comes time to actually understand their actual inventory, how many units are sitting in this warehouse versus FBA versus on a container ship coming, stuck at a port, whatever it might be, we had a difficult time getting the seller to be organized enough to really track down what deposits have I made that are pending, what in transit containers are on the water, what's being air freighted, what is the impact of my duties on these versus the last load versus the one before? And so having some fairly detailed, kind of obsessive level inventory tracking becomes very, very important as you get close to going through due diligence. And it could just be spreadsheets, but it needs to be detailed. It needs to be fairly obsessive where you can track every PO, deposit date, when did it land, when did I fully receive it, when did I make the last payment, so that you can tell a coherent story to your buyer. So that's the fourth thing is you may have good accrual books and still have crappy inventory tracking. It's time to start tracking your inventory more effectively. Finally is no tax compliance. So, what I'm not saying here is that you have to have filed for sales tax in every state. I don't believe that's a great strategy at all. I for sure wouldn't do that. What I mean here is, have you assessed your sales tax liability and made a coherent strategic decision around filing for sales tax, but not just sales tax? How about other taxes? Do you have employees in states that could create exposure for your potential buyer? Are you one of these guys that just hasn't filed a tax return with the IRS for income taxes over the last 3 years? That can be a red flag in these deals. We're like, wait a minute. You owe taxes and haven't filed your taxes for the last 3 years, and now you're going to submit these financials to us, and you're going to tell us to trust you and maybe give you $1 million. So come on. So make sure that you are caught up and compliant within your tax universe. That does not mean, I'm going to say this again, that you need to go file sales tax or income tax in every state. You need to talk to your CPA or your SALT counselor about that. By the way, we love taxvalet.com. Those guys do a good job on sales tax. TaxJar.com is a good software for sales tax. And your CPA for your income taxes is the right advisor for you to go to for, hey, have I filed my taxes correctly? But you want to have your taxes in order, frankly, before you go to market. So those are the 5 deal killers. We've seen them. You don't want to fall prey to these. Don't hide from your buyer. Don't lean on black hat tactics. Make sure your books are not commingled, that they're good accrual accounting books. Make sure you're tracking your inventory really, really closely in the months coming up to your sale, and make sure that you're compliant with taxes or have a coherent strategy related to taxes. So thank you again for joining me for this video. If it serves you, please share this with your friends. Have a great day. Take care.